In this video, we will explore about the regulatory infrastructure and important regulations in financial markets. Just like a building needs a strong foundation to stand tall, financial markets need a solid structure of rules and regulators to function correctly. As you can see on the screen, the financial markets roof is supported by a strong pillar called regulations. This structure exists for three main reasons: to ensure everyone behaves responsibly, to protect your interests as an investor, and to keep the market fair and competitive for everyone involved. Now, let us look at the big boss of this infrastructure, the Ministry of Finance. This is the government body that manages the money of the entire country. It is split into 5 key departments. First, there is the Department of Economic Affairs. They are the nodal agency for big picture economic policies, and they oversee the capital markets and stock exchanges. They also prepare the union budget every year. Next is the Department of Expenditure, which manages how the government spends money and sets rules for government employees. Then we have the Department of Revenue. These are the people who handle your taxes, both direct and indirect, through boards like the CBDT. Fourth is the Department of Financial Services. They cover banks, insurance, and pension reforms, looking after the services you use daily. Finally, there is the Department of Disinvestments. Their job is to manage the policy when the government decides to sell stakes in public sector companies. Moving on, we have the Ministry of Corporate Affairs, or MCA. Think of them as the gatekeepers for companies. Their primary job is corporate administration. They administer the Companies Act and manage the Registrar of Companies, where every company must register to be legal. In the center, you see their role in competition. They administer the Competition Act of 2002 to prevent monopolies, ensuring that big companies do not crush small ones unfairly. Lastly, at the bottom, they supervise professional bodies. This includes the institutes for chartered accountants, company secretaries, and cost accountants. Next, we have the heartbeat of the Indian economy, the Reserve Bank of India, or RBI. Their main goal, as written in their preamble, is to keep monetary stability. They wear many hats. As the monetary authority, they control the supply of money to keep prices stable. They act as the financial system regulator, setting the rules for banks to ensure your deposits are safe. They are the sole currency issuer, meaning only they can print the notes in your wallet. They also act as the foreign exchange manager, handling external trade laws. And finally, they serve as the banker to the government and to other banks. Now, let us talk about the protector of the stock market, the Securities and Exchange Board of India, or SEBI. Imagine a shield with 3 layers. The first layer is protection. SEBI protects the interests of investors like you. The second layer is promotion. They promote the development of the market so it can grow. The third layer is regulation. They set the rules for stock exchanges, brokers, and mutual funds. They prohibit unfair practices like insider trading and have the power to conduct audits and inspections to keep the market clean. Since 2015, they also regulate the commodities market. Apart from the big regulators, we have sector-specific regulators. For the insurance world, we have IRDAI. They license insurance companies and protect policyholders to ensure claims are settled fairly. For your retirement planning, we have PFRDA. They regulate the pension sector and the national pension system to promote old age income security. And for when things go wrong financially, we have the IBBI. They oversee the insolvency and bankruptcy process for corporates and individuals, ensuring a smooth exit or restructuring when businesses fail. To give this regulators power, we have specific laws. One of the oldest is the Securities Contracts Regulation Act of 1956. This act gives the central government and SEBI the power to prevent undesirable transactions. It allows them to recognize stock exchanges and even suspend their business if they are not functioning correctly. It basically controls how securities are dealt with to stop bad speculation. Then came the powerful SEBI Act of 1992. This act gave SEBI its teeth. As you can see on the diagram, it grants 4 types of powers. First are registration powers, allowing them to register brokers and mutual funds. Second are regulatory powers to set the rules of the game. Third are enforcement powers. This is crucial because it allows SEBI to call for information, conduct inspections, and levy heavy penalties on wrongdoers. Fourth are educational powers to train intermediaries and educate investors like you. One of the biggest crimes SEBI fights is insider trading. Let us define who an insider is. It is any connected person or someone who has access to unpublished price sensitive information, or UPSI. A connected person could be a relative, a banker, or a subsidiary company associated with the firm in the last 6 months. And what is UPSI? It is any secret information like financial results, dividends, or mergers that hasn't been made public yet but would definitely change the stock price if it were known. To stop this, there are strict compliance rules. The golden rule is shown on the top left. Do not communicate secret information and do not trade while you have it. If you are a key person or promoter, you must make an initial disclosure of your holdings within 7 days of your appointment. Companies also use a Chinese wall policy. This creates a barrier between the inside areas where employees have secret info and public areas like sales and marketing. Employees cannot cross this wall and share information unless it is absolutely necessary for business and documented. Another major area SEBI policies is fraudulent and unfair trade practices. What counts as fraud? It is not just stealing money. As the path on the screen shows, it includes willful misrepresentation of the truth. It includes active concealment, which is hiding a fact is important. It also includes making a promise without any intention of performing it. Even if no one loses money, if the act was deceptive, it is considered fraud. Let us look at specific prohibited dealings. SEBI investigates manipulative practices. This includes mis-selling, where risks are concealed from the buyer. It includes circular transactions, where brokers buy and sell among themselves just to create fake volume. It includes front running, where a broker buys a stock for themselves before executing a large client order. If SEBI catches this, they have the power to suspend trading of that security, restrain people from the market, and even impound the money made from the fraud. Now, let us switch gears to research analysts. Investors rely on experts for information, but there is often a conflict of interest. For example, an analyst might recommend a stock just because their firm has a business relationship with that company. To fix this, we follow the IOSCO principles. These rules ensure that trading activities do not bias research. They demand that firms have written procedures to manage these conflicts and that all disclosures must be clear, prominent, and timely. To ensure quality, SEBI introduced research analyst regulations in 2014. If you want to become a certified analyst, you must follow this path. Step 1 is eligibility. You must be a fit and proper person with no disciplinary history. Step 2 is qualifications. You need a graduate or postgraduate degree and a specific NISM certification. Step 3 is capital requirements, meaning you must maintain a certain net worth. And finally, step 4 is the grant of certificate. Once registered, you can officially issue research reports. Finally, let us understand what happens when companies fail. we use the Insolvency and Bankruptcy Code or IBC. The process starts with a trigger, which is a default of more than 1 lakh rupees. It can be initiated by creditors or the corporate itself. Then comes initiation, where an interim resolution professional takes control of the company, suspending the old board. This professional forms a committee of creditors. Then comes the resolution phase. They have a strict deadline, typically 180 days, to come up with a plan to either restructure the company or take it over. The outcome is either a successful resolution where the company survives or liquidation where the assets are sold off.